Well, hello and welcome back to Jones Financial Talk. This is Nick Jones from Jones & Associates Premier Financial Solutions. Listeners, it's been a little while since you maybe listened to the show. So if you'd like more information about what you hear on this show, please go to our website at jonesfinancialtalk.com. You could also give us a call if you have any specific questions at 541-500-4321. You can click on the radio page if you go to that website, by the way, and listen to all of our past shows. You can even subscribe to our program on Apple Podcasts, Spotify, and even Amazon Music. Coming up here in the fall, we've got the election in just a couple of months. And a huge topic for the candidates is going to be what's going to happen to taxes next year. The Tax Cuts and Jobs Act of 2017 reduced personal income taxes for many Americans, but that specific act does actually expire at the end of 2025. And so if Congress doesn't act, taxes could rise for many households. Nobody's going to be able to predict what's going to happen, and Congress has really three choices. Okay, they can extend the legislation as is, they could adapt it, or they could just let it expire. And so this is going to be a huge hot topic that I'm hoping our candidates address in the different debates that they have, and obviously before we vote for them. But today, let's talk about that Tax Cuts and Jobs Act of 2017 so that everybody understands what's at stake here. Before I do that, I'm going to bring my amazing co-host, Mr. Tony Shore, in to help us explore that topic. Hey, Tony.
Hey, Nick, how's it going? It's been a couple of weeks. I know you've been doing some traveling and been keeping really busy, helping your clients there. But it is good to see you. It's great to be back on the show with you today. And I've been great. I just can't believe it's already football season. Preseason has started. I mean, where did the summer go? It just flew by.
Where do the years go in general, right?
Yeah, well, as we get older, at least I'm getting older. You don't age, of course.
Of course not, yeah.
You don't age. But as I get older, it's just a blink of an eye. Okay, summer's done. Now we're headed toward fall. But I do love this time of year, and hopefully we'll get some nice fall days and love football season. So I'm excited about that, but I'm also excited about the show today. Now, Nick, how have you been? You've been busy, haven't you?
I have. This has been a busy summer. Always in the Rogue Valley, as many of the listeners know and understand. We struggle with fires and smoke. We've had a little bit of that.
Yeah.
And record temperatures here in the Rogue Valley this summer, but things are starting to cool off, and nice. We've got some clean air to breathe. So I'm happy that we're going into the fall. Obviously, a very, very busy time. We've had some significant volatility in the markets. I think listeners, you should expect significant volatility between now and the election for sure. And August and September are typically months that struggle. We typically struggle in those months during the year when you're thinking about market returns. So make sure that you're talking to your advisor and talking to them about things that you can do to put yourself in a better situation this fall before we hit 2025.
Right. And you always say on past shows, you've always said, hey, we're going to have market corrections. Don't panic. Right. And, a week or so ago, a couple of weeks ago, we had some panic because Monday morning, the markets opened up a couple of weeks ago and they were down. We were seeing a bit of a correction. But of course, they went back up again, and people should not panic. They should have a plan and work with somebody like yourself. Now, I have to play a quick clip here, Nick, because my friend Robin happened to be on an airplane Monday morning, and the pilot wasn't working with a financial advisor, and he was panicking, and that you don't want that. So check this out.
It's interesting to be here. Flying down there's a little scary. They always have a pilot going, hi, this is your pilot. Before we take off, I just want you to know I invested a little money in the stock market. And let's see if those insurance forms pay off.
So a little Robin Williams clip from years ago,
Classic.
Back in the 80s, I think, when he was on the Tonight Show, and he happened to be on there a week when the stock market had taken a dip. So that's what makes that
probably
funny.
87. That was a terrible crash that we experienced,
Black
Monday, as they call it. And, you're right, though, Tony. A lot of clients have asked me, like, what's going on? What should we be thinking about? And this, in normal market cycles, when we have good returns, it's called a bull market. And that's what we're in the middle of right now.
Sure.
But every bull market has 5 and 10% pullbacks.
Yeah.
And, we haven't had that big of a pullback in about 2 years. And so these
Which
are
is
expected.
abnormal. So the people are expecting a pretty serious correction. That ended up not being a big correction, but a slight sell-off because of the jobs report, right? I mean, these things, they're blips, and, there could be a bigger correction coming, but the key is not to panic and to have a plan. So.
Well, and if you think about, longevity and what you're trying to accomplish with your specific portfolio, you've got to look at the broad picture. And actually, just today, there were some very good economic indicators that came out that talked again about the fact that inflation is in control. And so the market has been up big the last couple of days. And that's a perfect example. I mean, there's typically more positive things going on today, in our economy than negative. And what that typically means is directionally, you're going to continue to move in the upward direction.
Yeah. Okay.
But I mean, taxes are almost as important as investment returns, because if you can save clients 5 or 10% a year on taxes, that's like getting another 5 or 10%, right, in investment returns. So this is a huge topic I want to discuss today.
Yeah, it is a huge topic, and taxes are a big part of it, and people's money, and they always play a part, no matter what you're talking about, investments, retirement accounts. So where do you want to begin with this topic?
So for the Tax Cuts and Jobs Act, right, let me just, at its basic level, let me explain a couple of things. I mean, it was a massive overhaul of the federal tax code that took effect in 2018. In fact, it was the largest piece of tax reform in 3 decades. And what it did is it created a corporate flat tax rate of 21% for corporations in our country, and that was permanent. There were also numerous tax cuts for individuals that were temporary. And those are the ones that expire if Congress does not do anything or choose to do anything at the end of 2025. And that's why it should be a topic that you are discussing with your advisor right now.
Yeah, and that it should be, and taxes always should be, but especially this, because it's historically low, the taxes right now, and I think I remember what the tax cuts for individuals were, but give us a recap of exactly what the tax cuts were.
Okay. And it's been 8 years. So a lot of people probably forget what it used to be like and why this is so important.
I don't remember all the brackets. I remember my bracket.
Yep. So for pretty much every bracket, it lowered taxes. Okay. So here's kind of the big numbers. The top tax rate dropped from right at 40% down to 37%. And the 33% tax bracket dropped 1% down to 32%. A couple of the big drops were for most middle income Americans, where the 28% tax bracket was reduced down to 24%. The 25% tax bracket was dropped to 22%. And probably the biggest number, the 15% tax bracket, was slashed down to 12%. So that was a huge difference for people that were right around the, say, $70,000 to $80,000 income range, when that took place.
So, and that means if you're in one of those tax brackets, your taxes will go up at the end of 2025 unless Congress takes additional measures, right?
That's right. Congress has to either extend the act or pass some type of similar legislation. Otherwise, those brackets will automatically go up once that act expires at the end of next year.
Yeah.
And so, the legislation that we're talking about also increased the standard deduction, which is a huge number today. If you recall, listeners, this year, the standard deduction for single individuals is $14,600. And for married couples, it's $29,200. And that also will change, during this kind of movement away from the Tax Cuts and Jobs Act, as well as the personal exemption that is still in effect through 2025.
Sure. So what exactly is the personal exemption, though?
So the personal exemption was a flat $4,150 that was available to every single taxpayer. And while the legislation ended this particular deduction, it made up for it by modestly increasing the standard deduction. Today, think about it from this perspective. Most people that are single have $15,000 of write-off right up front with the personal deduction, and married is almost $30,000. So
Wow.
if you remember 8 years ago, you'd have to have that much write-off to be able to not come out ahead when you're doing your taxes. That's very difficult for most people.
Yeah, which is why almost all of us use the standard deduction, right?
That's right.
That's right. Yeah. So I'm probably stating the obvious here, but if any of our listeners out there, Nick, are concerned about the expiration of this Tax Cuts and Jobs Act and what it could mean for them, their first step should be talking to somebody like yourself, reaching out to you, right?
Yeah, I mean, there's clearly their accountant is going to be an important resource as well, but
Sure.
Your accountant is probably not going to give you tons of ideas of what you could do. And if you're working closely with your financial professional, they're going to have the ability to look at what your investments are, give you different options, talk to you about different maybe solutions that could help reduce those taxes.
Sure.
The other thing I wanted to mention here, Tony, too, is the Affordable Care Act.
Yes.
And if you remember,
that's impacted by this too, isn't it?
It sure is. And when it was signed into law, it included tax penalties for people who neglected to buy health insurance. But the Tax Cuts and Jobs Act of 2017 that we're talking about eliminated that requirement. Okay. So that was a huge thing. The other thing that it did is it also increased the child tax credit to $2,000. And so there's lots of different things that have helped most Americans with this specific Tax Cuts and Jobs Act of 2017. Another big one that maybe doesn't affect everybody, but it does affect very high net worth individuals is the estate tax issue. Okay. And so the legislation increased the estate tax exemption federally up to $13 million. And like every other part of the Tax Cuts and Jobs Act code, that will expire at the end of 2025 if things are not worked out. And so in any tax bill, Tony, there's tons of different specific things that can be affected. And all of those things were a very good thing for most Americans because it reduced taxes. It reduced their legacy play. It increased deductions for certain things. And so most people benefited from it.
Yeah, and that's true. Now, you said maximum. What do you mean by maximum?
Okay, so the maximum amount of an estate that you can transfer to somebody, a beneficiary, is important to understand before you trigger some type of an estate tax federally. Okay. And that number today is right around $13 to $14 million. And that would be reduced in half almost down to 5 million or 6 million in total assets before you would start paying some type of an estate tax federally. This is not to be confused with the state level. And Tony, you live in Minnesota and I live in Oregon. And both of those states have huge estate tax implications if you're not planning for those as well.
It's much lower than the federal, I'll tell you that. Right. It doesn't take much. If you inherit some land or a farm, or you're gonna get hit with those estate taxes.
I can't recall the exact number in Minnesota. Maybe it's 3 million.
It is 3.
But in Oregon, we are the lowest in the nation. We're at $1 million. So if you inherit over $1 million, you will have some type of an estate tax.
So a family business or farm or land or home, anything, savings. That's tough. That's really low. I thought 3 million was low.
Yeah. I would be very surprised if listeners that are hearing us today have asset levels of that size, have not ever discussed that with their advisor. If they haven't, then they definitely should be picking up the phone and calling somebody
you need
else.
to figure out what to do to avoid those taxes or minimize that burden for your loved ones. So let's imagine a hypothetical here, Nick, a situation where the Tax Cuts and Jobs Act is allowed to expire untouched. What happens? So if whoever gets elected doesn't renew it, or if Congress doesn't act, what happens then?
So just on the federal level, when we're talking about estate taxes, that basically would cut the exemption that you have in half, and meaning that taxes would be owed on an additional $7 million of anybody's estate that has, 14 million in an estate today. So that just opens them up to tax liability of 50% more in that specific situation. Once again, this is something that you need to closely monitor if you have a significant estate, to see how Congress is going to handle the legislation in the months prior to its possible expiration. And depending on who gets into office, this is a topic that should be discussed a lot to understand what's going to happen. It doesn't matter which way you tilt politically. Politicians want to spend money. And the only way they can do that if they don't bring enough revenue in is to raise taxes somehow, right? Or take something away. And so it's just dependent on how they're going to change that, how it's going to affect you personally when that happens. And unfortunately, Tony, many clients we work with are seniors that are somewhat on a fixed income. And this can be a huge disadvantage that they can't control. They can't go back to work. They don't have the purchasing power that they used to when they were working. And so something as little as a minor tax change could implicate things drastically.
Yeah.
I mean, a 1% increase, if you make $100,000 a year, a 1% increase in taxes is $1,000.
Yeah.
That's not a small amount of money. And if it's a 4 or 5% swing, you're talking 4,000 to 5,000.
Yeah, you don't want that. So you've got to find ways to minimize that tax burden. You have to pay attention to what's going on. And that's why I love the fact that that's what you do for your clients is you're on top of these things. You can plan for this taxes in retirement or as you go, as you're investing. So I would encourage our listeners to give you a call. How can our listeners out there set up that no charge, no obligation consultation?
2 very easy ways. They could just go to our website at jonesfinancialtalk.com, request more information, ask any specific questions, happy to talk with them. Or they can just pick up the phone and give us a call. Our main office line here is 541-500-4321.
All right. So we're talking today, Nick, about the Tax Cuts and Jobs Act, and that's set to expire at the end of next year. And if that happens, like you just said, it likely means taxes will go up for many of Americans, though Congress could extend the legislation or revamp it. What do you have next for us on this?
So, maybe for some of the listeners that have not thought through these specific things, there are definitely some specific tax strategies for retirement withdrawals. The tax implications for retirement withdrawals are one of the biggest concerns that I talk to clients about.
Sure.
So, one of the first pieces of your strategy should be ensuring that you avoid early withdrawal penalties. Okay. And if you're taking money out of a traditional 401k or an IRA before the age of 59 and a half, you could be subject to additional penalties up to 10% of those withdrawals. So you're essentially just giving more money away as a result of not doing it correctly. There are a couple of very specific ways if you're under 59 and a half and need money out of your retirement accounts before you turn 59 and a half to draw those out penalty free. And you would need to sit down with your advisor and talk about the pros and cons of that. But it's definitely possible to avoid those early withdrawal penalties if you utilize the money in a correct way, or if you use it for some approved expenses. Some of the things on those approved expenses list, Tony, are things like medical bills, college costs, or even buying your first home. So lots of things that are in the tax code that can help you. But the point I'm trying to make here is before you take money out of a retirement account, make sure you have a tax strategy that's built for it.
Right. And a tax strategy that's thoughtful and broad when you're considering those retirement withdrawals for income. That's, again, a really important reason you need to be working with a financial services professional like yourself. And I think retirement withdrawals are too critical to my overall retirement strategy and success to begin them before getting an opinion and a plan in place from somebody like yourself.
Yep. And there's just little basic nuances that you should definitely be discussing, right? I mean, in many cases, you may be able to roll over your 401k without any tax withholdings. But let's say that you take money out of your 401k when you change jobs. In that scenario, your employer, right, may withhold up to 20% to cover income taxes. Then if you don't quickly put the entire distribution, including the 20%, into a different retirement account, you could be slapped with income taxes on a lot of the money that you're trying to get out. So there's many ways that you can avoid that and both avoid the tax withholding situation as well as those possible penalties if you directly transfer money, or if you work with a financial advisor that can help you do that so that you don't have to worry about those specific things.
Yeah. So how do RMDs, or really massive donuts, fit into all this? I'm sorry, RMD stands for required minimum distributions, doesn't it? At
Yep.
some point, when you reach a certain age, 73, I think it is, they make you start taking out money, right? So,
Yep.
and then that money is taxed if it's a tax deferred account. How does that fit into all of
Yeah,
these?
so the government obviously is trying to take some taxation out of your retirement account starting at some specific age. This has been a very complicated thing in the last couple of years because just in the last couple of years, the age at when you have to start this has changed many times. But you are correct, Tony. Today, you're required to withdraw money out of your traditional 401k or IRA account if you hit your 73rd birthday. And it's a huge penalty for not taking the RMD. It's 25% of the total that you should have taken out. And then don't forget, you also would have a penalty on the income tax that's supposed to be withdrawn. Now, luckily, if you notice the error and you correct it promptly, okay, then the penalty may drop to as low as 10%, or you might be able to get it completely removed if you work closely with an advisor. But the point is, if you're still working, then you have a different option. Okay. If you've turned 73, you're still working, and you don't own a significant portion of the company you work for, you may be able to delay those withdrawals if the money is held in your current 401k plan. Okay. But this does not apply to IRA withdrawals. You are subject to those IRA withdrawals at that age of 73. And to complicate things a little bit more, the age is moving up to 74 and 75 in the next 5 to 7 years. You're on mute.
Really? So I think that's interesting. So it'll probably be 75 for us, you and I.
Yep.
And that's interesting. I'm glad they're extending it. But I think in older RMD age, even if the change is still a ways away, that's a factor that a lot of people listening will want to talk to somebody like yourself about and make sure they're working that into their plan, right?
Yeah, and you should next be careful to not inadvertently take two distributions in the first year. This happens to a lot of people because you do have the ability to take your first RMD distribution no later than April 1st,
right?
In which the year that you reach the age.
Sure.
But realize that if you do that, you're going to take two distributions in 1 year.
Yeah.
So delaying
the
it might
tax.
sound
Yeah.
like a great thing, but then you're taking twice as much out. You could be in a higher tax bracket as a result of that. So you got to discuss those things to figure these out.
Right. And correct me if I'm wrong, Nick, but considering especially that, there's probably reasons for people, a lot of people, not everyone, to start taking withdrawals before they turn 73 and even are forced to. I mean, they might need to, but they might want to spread that tax burden out too, right?
That's right. You are not required to take any money out before 73, but if you begin smaller distributions while you're in your 60s, that totally is going to help spread your tax obligation out over many years. Another thing that you could think through here is Roth conversions, right? If you convert a lot of the money from an IRA specifically into a Roth, depending on your tax situation, you'll have less money that you'll have to take out at the age of 73. So another big thing that you should consider for sure. Yeah.
So obviously you want to make sure you're looking at all these different aspects and everything that you need to do here. So you need to work with somebody like yourself again. And if our listeners need to get a hold of you, how do they do that?
So 2 easy ways, listeners. You can just go to our website at jonesfinancialtalk.com or give us a call locally here at 541-500-4321.
Yeah. All right. Well, let's keep rolling. What else do you have on this topic? Is there anything else you want to cover?
So another way to reduce your taxes, right, that we could talk through and that we have mentioned on some shows is moving your IRA distributions to one of your preferred charities. So if you already give money
Oh,
away and you're over the age of 70 and a half, you can avoid paying some income tax on IRA withdrawals and RMDs up to about $100,000 a year for each person. Now, the qualifying charity that you choose and the donation that you make does need to be paid directly from your IRA to that charity. So you can't take the money, put it in your account, and then write them a check, is what I'm trying to say.
sure.
So if you do this, correctly, what happens? Well, typically the donation that you make is not taxable to the charity because they're a charity. But then on top of that, you're not paying the taxes on the money that you're giving to them. So if you don't do it that way, let's just say that somebody is taking $10,000 out. Okay. Well, if they're in middle income tax bracket, they might only get 7,000 or 7,500 of the 10,000 after taxes. Right. But if they send it directly to a charity, they don't have to pay any taxes and
Yeah.
the charity gets the full 10,000.
Some people give money to their church every month or every year. And so let's say you're giving 10 grand a year to your church. And you're writing a check. I know a lot of people who do that. They tithe
Yep.
to their churches and they write a check. Well, that's after tax money. So they've paid the whatever, a few $1,000s if they're middle income on that money that they wouldn't have had to pay. They could have had it transferred directly from their IRA to the charity or the church and they would have avoided paying the tax on that money, right?
Definitely. And what would happen? The church would get more money.
Yep.
And you wouldn't be paying the taxes on it, right? You're totally right. So yeah, if you're putting $1,000 a month to your church, yeah, that could be $3,000 to $5,000 in taxes that you're paying before you even push it that direction.
Yeah, that's one example because I know a lot of people who do that. And so if you're doing that, wow. And I know I watched my mom and dad write a check and I've written checks to my church and I'm like, wow, I could, if I'm in retirement, once you're that age, I think that's something my mom and dad could have done differently once they reached that age. They should have probably done the charitable distribution directly from their retirement account.
Yep, that's just a huge topic. We've got lots of clients that are very lucky that they can live on their typical income needs and don't need a lot of the money out of their retirement accounts, but they're forced to take it out. And so this is an easy way for them to do something really good for their community and do something really good for their own tax situation.
Yeah, and not get bumped up into a higher tax bracket because they're taking it out first, too. That's right. Also a consideration. Well, I think that's great. And charitable distributions, and you had mentioned Roths, that's so important, too. That's a great way to really watch your taxes and have a tax-free bucket of income in retirement. So we've covered a lot today, but we're out of time. So one more time, we want to let our listeners know how to get a hold of you, or if they have more questions, where to look for answers.
Sure thing. If you're not talking to about taxes with your advisor, you should be. This is a huge thing, once again, clients and prospects. But you can get a hold of us in two ways. Just go to jonesfinancialtalk.com or pick up the phone, give us a call at 541-500-4321.
All right. Well, Nick, great show today. Thanks for all the great information. And listeners, that does it for today's episode of Jones Financial Talk with our host, Nick Jones.